Hi everyone, thanks again for joining for another episode of the World of Oil Derivatives. I'm joined by the lovely research team again, Audrey, Ehsan and Vincent, and we're going to go straight into it. So, it's only been a few days. Ehsan, do you want to start this time? What's the kind of summary of what's going on?
Yeah, in terms of like the trading activity at the moment, we are sub 80 on the flat price. Market pretty range bound. Sometimes there are moves, with headlines. It's quite interesting regime at the moment because this market seems to be very much headline driven at the moment. And with new information coming out, like we had the US manufacturing numbers coming out yesterday, which supported the flat price for like 2-3 candles, but then after that the price is retraced back, and it doesn't seem like at the moment there is enough consensus for like directional moves in the price, at least for the flat price.
Well, it's moving downwards though, right? You mean in line with consensus, or?
Like it is going downwards if you look at the daily charts. But again, on a weekly basis or like on a monthly basis, it seems like we are in a quite tight range between like 70 to 85. What's that?
Oh, this is funny. It's like a pretty big deal what's going on, though. It's like when I was 86, everyone thought it was going to be like really, big rally. That didn't survive, came all the way back off. We're below the psychological level of 80. We're downward trend. It looks really...
Yeah, I think the way I'm looking at it is like more in like a zoom.
Translating your tiredness.
It's more like in like a zoomed out version.
Yeah. No, fair enough.
Yeah.
But I definitely feel like the theme of what we've been saying in the last few weeks is the lower open interest, lower kind of consensus building, and those who are in it, i.e. the hedge funds from the evidence, they are reactive to price after their entry, of course, right? They don't hold things for as long as kind of the oil traders, and they're definitely nervous, you would say. And the data, right, Vincent, that's saying that, and we could be seeing stop outs there in a big downward trend, no?
Yeah, definitely. A lot of basically there's a lot of short investors going to gas oil, but also, of course, in Brent and WTI, the net bias is decreasing by a lot compared to a couple of weeks ago. Seems like the excitement of the OPEC cut has been very, very short-lived, and hedge funds just are not confident about the outlook for oil prices, especially with a lot of economic headwinds. You still have inflation, interest rate rises lurking around the corner. Of course, if you're listening to the wider market, the oil influencers, they're like, oil could still go up. There's going to be a very, very strong second half of 2023. We're going to see if China is going to finally come online. They are coming online, but are they going to meet expectations in the second half of the year? So everyone, it seems like, obviously not everyone, but the market likes to be bullish. But one thing I think we've talked about in the last few weeks is, what if oil goes even lower? If it goes below 70, probably we'll see a lot more stop outs. And the question is, what might oil look like at $60 a barrel? Because that's going to be pretty good for consumers, like end users, me and you, for the drivers on the roads. Like what Trump used to say, it's like a lower oil prices are like a tax cut for the consumers. So that's an interesting scenario to think about.
Well, one thing about the second half argument, there's all like a lot of like market research houses are just like looking at the talking about the second half of the year, Q4, Q3, and like the strong demand in the market. I think the least thing is that like this should be reflected in Brent spreads, and at the moment it doesn't really seem to be the case, right? We've got to at least see some bets in Q3 and Q4. There's just
what that would translate to what people are saying.
Exactly.
Are they actually positioning that way?
Exactly.
Yeah.
There's no evidence of such thing.
Do as I say, not as I do.
Yeah.
No, well, like it seems like in this CFTC.
Mate, you're so
like-
tired.
Yeah.
You up,
Say
you
that
up
one more
5?
time.
Were
No,
you
no,
up,
no.
were you up at 5 this morning? Like,
I was at the office at 6 a.m. Yeah.
what time did you get up though?
5, yeah.
And what time did your kid wake you up?
That's the problem,
Okay,
because
right.
last night I was up for like until like 3 a.m. or something. So
Okay.
Wow.
Oh no.
yeah. Maybe had a nightmare because she was like being really, really aggy, and
Fair enough. But what your point? So yeah, the evidence
I'm
is
up
not
and
there.
sharp though. Like it's yeah.
Yeah, no, it's a good point. It was a good point. So okay, so the positioning, like Vincent said, it's mainly the concentration's been a lot on gas oil. That's been gaining a lot of momentum. You know, traders at the end of the day want to trend either way. It's been trending south on the gas oil crack, like relentlessly, way below where people thought it would be possible this year. People were hoping it would maintain kind of 40 levels. We're back to, you know, teens, low teens, even further south potentially. And hedge funds are jumping on it. There's a lot of momentum there. And if everyone thinks it's going to be a second half tightness, I guess you're saying you expect to see the Q4 and Q3 buying then, and there's not many contracts that have done that. I mean, that can't be fully true. I think gasoline, the Q3 contracts, there is a bit of length coming in, but I know what you're trying to say. It's if it's going to be reflected, it should be reflected in the curve, and that's what our data is all about, and we're not seeing it.
It's quite interesting to note that, like, at the moment, the amount of like short positioning by the money managers that there is in that contract is more than the length, which is something quite rare that you see, especially in products, refined products like gas oil, because like usually, you know, everybody's long that because there's a good good demand generally for these refined products, and it's not easy to justify to bet against these. But at the moment, there's definitely consensus among the market participants that this needs to come under pressure. Essentially, like people are betting on that, and currently the long to short ratio is I think on the 10th percentile. So it is a very, very rare event to see such short build up. One other thing, like looking at the back of the curve as well, like we're looking at like the EBOB crack at the moment. In October, November and December.
The European gasoline.
So the European gasoline, yeah. And
There's
generally,
been a hell of a lot of buying in the last 7 days, right?
yeah, but I guess the point is here is the open interest is kind of lagging behind the last 5 years around the same time. And if you go further down, maybe to November, again is kind of the similar case. It's not
so either the market is either not that convinced in this back end tightness, or it's just biding its time.
In a way, yes. So I guess in the East, that's slightly different. 92 crack, I think towards the end of Q4, there was a lot of positioning, especially in Q3 and Q4. But like the flows is buy side open interest higher than the 5-year average. So there's definitely some interesting stuff happening there. So people are buying back end stuff in the Asian benchmark.
But I think we had this discussion last week. I mean, it probably makes sense that the Asians more bought up because of the
Arbitrage opportunity to the US.
levels, right? So in Q3 we got pretty wide arbitrage from Asia to Europe, and then Europe to US. So that's probably on the back of that now.
Yeah, and also they are banking on this arbitrage opportunity to kind of continue into Q3 and Q4.
Yeah.
So that's like a real evidence of like betting, where traders are putting their money.
Another story actually. You want to say something? Go on.
No, I was going to say, because I find it really interesting. Well, maybe I thought it was interesting today. Was a guy saying overtrading is the number 2 killer of retailers' traders' accounts. So knowing when to stop distinguishes traders from gamblers. I thought it'd be interesting to get your reaction on that.
Yeah, I mean, what I was going to say was
These people in denial, like you're saying, like
yeah. And you just keep going and you
keep going.
Surely, if I keep putting it on red, eventually it will go red.
Yeah, and that like
in the
denial.
roulette table will say, now you're down your house savings. Yeah. No, I was going to say sometimes, especially when I first started trading, and it was a lot more inefficient as things were moving more towards the screen on oil swaps and things like that. And every so often there'd be like a mispriced number, especially in the full month, bow month type contracts, and something would appear on the screen and it would flash up on your system or whatever. You'd be like, that's off market, right? And you're trained to be instinctively, especially as a market maker, just go bam, you see something off market, you trade it. And the whole point is you're keeping your marks in perfect shape so you can react quickly to these things. And then you hit and you trade it, and it'd be like, right, cool, free money type thing, and it would still be there, as in it would refresh and it would still be a bid. You're like, okay, do I trade it again? Yeah, I'll trade it again. And then there was this, like, old boss used to say, it's like this rule of threes. So you do it 3 times and it's still there, you've probably messed something up, right? And obviously it can be dangerous. So you're weighing up between like a potential lost opportunity or a horrendous loss because you've mispriced things, and that happens all the time. So that's obviously, that's why your systems have to be like really on point, and you have to have a lot of confidence in that so you can react with confidence. And obviously these things don't happen as much anymore because it's more efficient. But I think it's relevant in this scenario because it's like you're so dogged in your belief that distillate demand should be here, therefore the crack should go up. So I'm just going to click buy. At what point are you going, no, you don't know what's going on here. You haven't factored in something. You need to take the risk off or not be in the trade. And that's what I think the big worrying thing is about that type of analysis. It might seem intellectual, but I just think it's dangerous.
I think a very interesting example was pre-OPEC cut, their banking crisis. It seems to be ancient history right now, but that was actually 6-7 weeks ago, middle of March, before Brent was chugging along at around $80. Then you had the SVB and the Credit Suisse stuff. All of a sudden, Brent sold off into the low 70s. And during that time, it doesn't seem like any of the oil fundamentals had changed. It was just the fast money, the hedge funds exiting their positions in oil. And or you could also say, because of the worsening economic outlook, people going on bank runs, there will be a credit crunch coming up. Okay, well, that translates into, how many less million barrels a day of demand, coming off. To calculate that seems sort of like, it's, if they want to do it like very precisely, that seems like rocket science. Or you can explain that, it's because people were very invested in Brent and they saw, they reacted to that and they had to exit their positions. And because there was so much length in the market, the sell-off was exaggerated. SVB, yeah.
Yeah, but in that scenario, couldn't you also say it's indicative of macro money being in the market?
Yes.
So if it reacted to an SVB situation, it's because they were using it as some kind of within their portfolio to have exposure to the macro environments. So it's just de-risking. That's why people like to call these things like risk off moves, right? Because they're like, look, I want SVB's going down. I had this macro portfolio that was expressing my macroeconomic outlook. Brent's part of that, right? I'm getting out of everything, which includes Brent, which then follows a sell-off. So now you can kind of say, well, that macro money, there's not as much macro money in the market now. So maybe the next reaction to the next macro headline won't be as big because they're out of it now. That's more the way you should monitor it. Like, what's the flow of money at the time? But just wanted to move on because we've got our crew trader Manny waiting on the call. So the good thing about this kind of time, so we're 2nd of May, so the first trading day, proper trading day of the month. It's when the new loading cycle of oil and oil products, crude oil and oil products, starting to price. So it gives you an indication of like the real evidence of what people think of the physical kind of 10 to 30 days out, or a bit longer if it's like NAPFA or whatever. So the expiry for Brent was last week, and where that trades is a very good indication of like underlying European crude demand, which is obviously used across the world as a benchmark. And let's get her on to discuss that and also what's happening this morning. There you are. Hi, Manny.
Hi.
Manny, we were just talking about the importance of expiry and the beginning of the new month, new loading cycles, and its real indications of what's going on in the physical. So what did the Brent expiry first off tell us on Friday about the kind of health and sentiment in the market at the moment on the physical side?
Sure. So coming into expiry, it didn't really look like there was particular strength. We saw the front spread hit into contango very briefly. So we came in with not too much of an expectation that people were going to come in really seeking barrels into expiry. So The cash traded very steady between 27 and 30. It seemed like the market was happy to transact at this level because there were a fair few trades going through. There are about 20 or so, kind of around 4 or 5 each window. So it's very...
and it's usually about what, like 5 for the whole day?
Yeah, relative to other expiries, it was fairly active, I would say. There were a lot of EFPs going through. And this was quite, optimistic for the future of the dated Brent market, seeing as we have now the inclusion of TI Midland, and people were sat on their hands for the beginning of the year, really, trying to wait and see what the sentiment was going to bring in. So there wasn't too much optimism about how busy the expiry would be. But Friday showed that people were happy with what to expect with June cargoes coming into the dated Brent market for TI Midland, and they're happy to transact on a new pricing mechanism.
So around 30 cents on the spread is where it's settled. So that's, plus 30 cents on a spread is plus 30 cents roughly on a physical differential, which is, obviously positive, and shows kind of roughly a balanced market. Is that how the dated Brent swaps, which are a bit more prompt reflection, is that how they're playing out as well?
So April was a bit of a extraordinary month in the fact that we had a decent rally. The first half of April was a bit tentative. We had a bull and a bear kind of taking each other on. The second half of April was allowed to price pretty strong. So we had dips of around 140, which was actually where we settled on Friday as well for April. So seeing a cash spread trade at 30 cents relative to where we're currently trading, is
in the prompts,
a significant sell-off as these June barrels come into pricing. So although the 30 cents dip looks healthy relative to where we are now, we are expecting some softness to hit the forward curve.
Very interesting. Okay. And what about the prompt Brent spread now, the first day of trading? How's everything looking?
To be honest, so typically the first day of pricing is pretty quiet anyway. A lot of people are sorting out their physical, so the paper market is very quiet, but there are indications that things are definitely softening. Okay. With a forward curve of 30 cents, if the market was inherently strong, we'd expect these rolls to come in and being bought today and slowly over the week. We'd expect May, June data buying, we'd expect CFD roll buying, essentially everyone looking for the roll-up trade because the forward physical curve is pricing 30 cents. Instead, we have good selling in the front. Trades are on the sell side of May, June. So it looks as though the market's consensus is that we are going to have a sell-off in the physical dips. And right now, it's suggesting that 30 cents is about where we're going to head to.
Great, thank you. Is there anything else? Anything else you're hearing, or would be interesting for us to talk about?
I guess the new thing is how TI will really start to respond.
WTI, right?
WTI into the dated Brent benchmark. So over the last 4 weeks or so, maybe 4 to 6 weeks, we've had an enormous rally in TI Brent boxes, especially. So I think we're around minus 40, minus 50% on the TI Brent boxes for a 1 month box, and now we're hitting around +5. So a substantial rally. But seeing as TI is now deliverable into Europe, with TI Brent so strong, it's looking as though it's not workable anyway.
What about the WTI Houston versus dated though, being a more Gulf Coast crude?
Yeah, the only problem is the liquidity in those.
But is in the levels? Are the levels suggesting the arbitrage is open, or?
No, so TI is landing very expensively in Europe. There are a few that were booked probably 2 months, 3 months ago, which are still landing. But any new bookings, it really doesn't make sense on the paper.
Great. All right. Thanks a lot for your time, Manny.
Sure.
So yeah, there's a lot to kind of unpack there. I think when you speak to traders, there's a lot of vernacular that, that's their day to day, right? So TI obviously referring to WTI Midland crude, which comes out of the Gulf Coast and is being exported over to Europe. and that's for the first time as of the June expiry on Brent is being included in the North Sea assessment, which is bringing in all these dynamics from the US over to Europe, and it's it's a pretty good indicator of demand. So I think what that kind of concludes is we're going to soften quite a bit, but not quite the panic that was being suggested by the contango in the front kind of just before expiry. So probably not complete doom and gloom at the moment. So it's just going to be an interesting couple of weeks. But anything you guys noticed there wanted to discuss?
I think the US export numbers are looking healthy. There was like a little bit of dip, in the first week of April, but over the last 2 weeks, it's been posting really decent numbers, going towards like 5 million barrels per day, so which is quite substantial.
Yeah, it's interesting. She's saying like the difference between, so to really hedge the arbitrage, there's WTI Brent futures, which a lot of people will know about, but that's not really covering the actual economics, right? That's one's in Cushing and one's a future, and it's two deferred. What you have to look at is WTI Houston swaps versus dated Brent swaps. And obviously that's what we cover in our dated Brent report, as you guys know.
MEH versus dated.
MEH versus dated, exactly. And she's saying, it's the barrels that are coming in from the US are landing expensively. In other words, that there's high physical diffs, and if you want the crude that's coming over from the US, you're going to have to pay up for it, because otherwise it's not worth it for these US traders. I mean, it's an interesting point, and we'll have to see how that affects export numbers as we go. But I think the evidence is that it's not particularly sensitive to the economics. In other words, the US guys are clearly keen to export no matter what, to some extent. It might be because they've hedged a hell of a lot ahead of time, or it might just be because it's a good outlet, and the US producers are looking at, if they generate a break even above $55 per barrel, if oil's around 75 and dated's around 75, like whatever it is, $1 or $2 here and there is not going to make a difference. They just want to get it out and into homes, into refiners. So that's going to be an interesting one. And that's the whole point. Now we've got this link to US that's really genuinely in the Brent price. It's a much more global contract now, even more so than it was before. And it's factoring in not just OPEC now, that used to be such a big driver in West African crude. It's now got the US. So we've almost got the whole world's oil in that contract now.
It's kind of like in line with what we were discussing last week about like the optimization of the routes, right? As in like the physical flows, especially with like the sanctions on Russia, their production and ending up in the east, and not so much of the North Sea production and the US production like finding their ways towards the east. So it is definitely that link between US and Europe is getting stronger and stronger, and it's also true in the nat gas market as well. Last week we were talking about this with Benny as well, and seems like at the moment that's quite a strong link. But one thing that Manny mentioned that was quite interesting is that Midland barrels or WTI barrels are landing expensively.
I literally just talked
what's that?
I literally just talked about that.
No, I was just gonna add something to that.
Mate, you're so droney, man.
I was just gonna add something on top of
definitely,
that.
Go on. Not usually sprucely self.
So initially I think the expectation was that Midland barrels, WTI Midland barrels, to price dated, because the mechanism is that the cheapest grade is the print for the dated benchmark. I'm still yet to see how the dated benchmark is going to price, or whether WTI Midland is going to be the grade which is going to be pricing the dated benchmark or not. So that's going to be interesting.
Seems like it's like you mentioned, is optimization of flows, optimization of the benchmark as well, because ultimately dated Brent relates to Brent, but the actual physical output's probably around like 1 million barrels per day, right? The streams are just dwindling over the years. It was only a couple of years ago that Troll was added to dated Brent. Used to be just a BFOE, and then just a couple of years later it's going to be Midland. Are they going to be as as the output dwindles in the future? Is it going to be like, is there going to be new streams added as well? What's that going to be? But it seems like the dated Brent contracts always evolving as well. I know it's been around since before I was born, and there's always seems like every few years there's some changes to optimize it, because otherwise it has to reflect what's the actual the sort of like the physical
Crude grades, yeah.
physical crude grades, the fundamentals of what's happening. It seems to be very localized, but the contract, the benchmark, also has to be a reflection of global oil as well, because you have like Nigerian crude all are priced against dated Brent.
Yeah. 70% of like everything
70%.
traded across all the grades.
Yeah.
Just like use dated as a benchmark to trade. So yeah, it is very important to make sure that there is like integrity in the way that like they do the pricing, and make sure like the benchmark is optimized. For sure.
So moving on to kind of wider news. I mean, what was this morning, Audrey? You were
No, just touched on it a bit briefly earlier, but yeah, I just found that tweet that was like getting trading to gamblers, and that knowing when to stop distinguishes the traders from gamblers. Just thought that was a really interesting kind of topic to touch on a little bit, because I guess when I explain trading to my friends who have absolutely no information about like financial markets, nothing, like they're in a completely different world, I do kind of explain trading as it's basically like punting, like at the races, similar to that. And I guess that's kind of what this guy was alluding to, but just knowing when to stop distinguishing them from one another. But I guess it's obviously a lot more nuanced than that, a lot more sophisticated being a trader than a gambler. I just wanted to hear, I guess, your reaction to that a little bit.
Yeah, it's pretty interesting.
Yeah.
I mean, like, obviously these things are always oversimplified to make a point, make a cool statement. But yeah, I mean, you probably know a lot more about this than you think, right? The difference, all those people who talk up cryptocurrency, the latest meme stock, it's funny how they stop talking, or no one ever talks about it when the markets move against them, right? Everyone just stops talking about it as if it didn't happen. It's as if like they were in a trance, they're out of the trance, and you can't remind them of when they were in the trance.
Yeah.
That's like a very like human thing, I think, and it reveals itself in trading. You're in the moment, you're so hyped up about it, and then it goes against you, and you have all this denial, like we were talking about with gas oil. Oh no, but it has to be here, and oh, don't worry. And then you go seek comfort and speak to all your friends. How come this is happening? Oh no, you're fine. The housing crisis, same thing. Right?
Yeah.
It's, whether you like it or not, we're all exposed to these emotions, and it's going to affect your life at some point, one way or the other. And people seeking comfort, being like, oh, let me ask an expert. Oh, you know what you're talking about. What do you think? Are house prices going to keep going down, or am I okay? Should I just wait? Nah, you'll be fine. Your house prices will come back up and you can sell it later. That's denial, right? And that could be hugely dangerous in financial markets. So I guess it is a good point. Like knowing when to stop is essentially saying knowing when to stop out. So knowing when to cut losses. It always seems like a defeat, and you're admitting defeat. And we could talk about this for hours, but yeah, every single good investor and good trader who's got a track record will tell you how important it is to stop out when things are going not necessarily wrong, or even it's not just about the money you're losing. It's that wasn't what your hypothesis was suggesting would happen.
Yeah.
Therefore, something's happened that you don't know. Therefore, get out. So that's really important, just from a kind of accepting that you're not you haven't got a sense of the market. So it's just dangerous to do anything else, because you're just going to have all the denial and all that kind of stuff going with it.
Yeah.
But also it's just about good risk management. If you stop out, you might have accepted a loss, but at least it's small enough that you can start again and go again and keep in the game. And just by staying in the game, sometimes that's all you need to do, right? Like I look back at Onyx's history even, and we've had a pretty north trajectory, but still the market conditions dipped massively in 2017 and 2018. Volatility got killed. It was not a good time to be in the markets. And actually through 2019 as well. And suddenly 2020 kicked off, and we had all the price war, the COVID. And since then, the trading conditions have been amazing. So just by keeping the business, going strong and building its foundations, we were able to really optimize and monetize from the amazing market events that presented themselves in 2020 onwards. So even if we'd made nothing, or even if we'd lost a bit, it would have been okay, because you want to just be ready for the times that that you can capture. So I don't know if that directly resonates, but yeah, it's nice to see people say like rational things as opposed to trying to hype people up and like, I just made $1 million trading this morning. That's the stuff that causes problems, if that helps.
But in this derivatives market, though, of course, you have both winners and losers, right? It's ultimately more of a zero-sum game, yeah. So, of course, you have the winners, the trade houses, the majors, they know what they're doing. But at the same time, there's a lot of losers. For example, when WTI fell into negatives, the SX boys, they won, but there was also losers on the other side, right? Losing billions.
Yeah, I mean that's yeah. I understand what you mean for almost every financial contract in isolation. The thing about oil or commodities is that because you have hedges, and hedges shouldn't care about losses, right? They're just there to fix prices.
Yeah.
They are to some degree providing money for the market if they lose, right? As in, if a producer hedges at $80 and it goes to 90, they've lost $10. They still make money on the physical. So it's not zero sum because they don't care that they've lost 10. It doesn't affect their overall economics.
Yeah, whatever firm there has got like physical optionality, basically.
Yeah,
whatever they do on the financial market.
So collectively, it's not zero sum, but it is in the derivatives in isolation. And remember, the end user is always the one that pays. I guess unless it goes negative, but even then, it's not like BP's going to like pay you to start using your car gasoline. So you never really benefit, right? The end user is always providing money to the market. So in an extreme condition, like an end user, a producer and a middleman and everyone in the market, apart from the end user, can make money, and the end user funds it all.
Yeah.
That is in theory a possibility, right? But the more financialized you get, the less hedging volume there is as a proportion for that financial volume. So the more zero sum it gets.
Okay, so if it's purely on a speculative basis, but then of course this market was made in the first place to help the physical hedges, right? To because they want certainty with future planning, the cash flows, all sort of that. It's from a management perspective, hedging is almost like a necessity. But at the same time, you got I think during COVID times, of course, oil prices came off by a lot. I think one of the something that a lot of people know is that airlines didn't fare too well during the 2020 year, because I suppose they had a lot of hedges locked in for the future, but then demand just went down. So they even though they could theoretically buy jet fuel at a very, very cheap price on the physical, because they already hedged on the derivatives market, they had to they suffered in the paper.
Well, they couldn't offset the losses on the hedging with their physical consumption savings because people weren't flying.
Yeah.
No.
So they were zero sum losing because their losses are usually offset by ticket sales and cheaper fuel costs. So that physical saving would have meant that would have offset, but instead it didn't, because the physical demand wasn't there, and therefore there's no ticket revenue.
Storage facilities. That's what they were missing, right?
Yeah.
Contango plays.
Yeah.
Well, an airline did buy a refiner in the US.
Oh, really?
Yeah, Delta Airlines. They it was weird that they bought a refinery, because like that when you buy a refinery, you're exposed to the crack, right? You're exposed to they wanted exposure to jet fuel, but it was jet fuel minus Brent, because you need to buy the feedstock. So they would have protected themselves on the jet crack. But if Brent had fallen, $50 or whatever, or risen $50, they've got no protection. They've got the protection to the crack, but whatever, they did what they did. And I think they made an agreement with oil traders to take everything off them apart from the jet fuel, and they'd use the jet fuel. Like, it's a pretty dynamic way of running a business. But Audrey, I was actually also talking about what you said about another news was the BP profit rising, right? That was announced.
That was interesting, and I actually just thought back to the couple of episodes ago now with your Just Stop Oil friends are definitely not going to be happy about this one. And obviously you've got some other companies coming out, some last week, some this week, all posting like massive profits, but their profits are actually down a bit versus 2022, obviously. I mean, there's going to be a lot of people, especially everyday people, like you said, at the end of the day, who pays for it all? It's the end users who are going to be really annoyed at this. It's going to be my parents filling up their car. It's going to be my neighbors trying to pay their electricity bills, seeing these massive profits of these big companies getting really, really angry at this.
Sure. But I think the news is that, but it's also been very heavily linked to profits in trading.
Yeah.
So that's becoming such a recurrent theme now, that I think BP in particular actually are relying on to fund their transition, fund their net zero transitions, because just because you're potentially producing less, you can still generate a lot of revenue on the trading side. I think in one of the calls a while back, he said in every project it adds something like, trading adds like 1 to 2% on the return on capital. So it's such a great business to have alongside. And it's no wonder that, the Aramco's, ADNOC's, but now Exxon in particular,
and Chevron.
And Chevron, they flirted with paper saying we're going to have trading desks. But I think they're now saying, like, there's just no way we can't have desks now. You can't. This is a public announcement. We're talking about it. Everyone's talking about it on the street, sees it. It's embarrassing if you don't have similar revenue, right? And they're all posting their revenue and their profits, and they never used to be. Well, they still aren't that transparent on how much is made specifically from trading, but the acknowledgement is that there is quite a substantial part, and it protects you against downward moves. Like in 2014, when the market sold off for the first time in a long time down to, $40 or whatever, and then had a lower for longer mentality. The majors and trade houses especially, but focusing on the majors because they're public, they did very, very well trading, and it was able to protect them against, pretty damn low prices and protecting shareholder returns. So I think whilst you might say, we can ride this out and we're back to making money, now that the transition looks likely and at least the sentiment's going that way, you have to find more dynamic ways to generate profit from your machine. And this is just putting that pressure on again and again and again, which is great for us because it's just more liquidity, more participants. So, like if Shell or let's say Totso or one of these guys were to exit the derivative market tomorrow, it's a big liquidity pool. Like we'd be trading a lot less. You would genuinely notice it day on day. It would be quite considerable. So we're adding like the biggest oil company in the world, and their flows are coming into the trading market. And it's not just them, right? There's a whole set of them that are huge businesses that are coming in thick and fast to compete with BP, Shell, compete with the trade houses. So it's just great. The market's just going to become huge. And actually, to your point about zero sum game, Vincent, it's interesting because they're going to be bringing a lot of hedging flow, which is what's been, causing a bit of a stir, right? How are markets driven these days? There's this big acknowledgement that financial volumes are so important. Well, actually, they should be liking this new hedging volume then, because hedging volume should have the impact of, stabilizing, maybe not stabilizing, but at least bringing physical sentiment, physical related flows into the market. And if people want the market to behave more fundamentally, that's how you'll get it. So that's pretty interesting on that front.
So you get some sort of better, closer correlation between the financial market and the physical market, and more impact from the physical flows.
So you get to a break-even point or a key point in the production levels, a rush of producer hedging. That's a fundamental impact of higher prices, and the vice versa for end users. So we're on this journey of big democratization and access for a lot more individuals than ever before and companies than ever before. And so it's not just the financial volumes that are coming through off the back of it. Do you want to go to sleep?
No, I'm okay. This is like the fourth time I think today that you just
bedtime stories. Anything else, guys?
No, quite interesting. It's all I think we always mentioned this before. It's there's a difference between of course we know we're providing liquidity as a service, all of these market participants, but then the public, they see a very, very different story. Of course, you have the hedging side. It's not quite a zero sum game, but what do the old Joe down the street think? It's all speculation. It's all gambling. It's when I first joined, I was my boss told me, it's just like a giant casino, and in some sense, trading the stuff with the brokers over the counter, it is almost like a casino, because as long as there's willing buyers and sellers, you can customize any contract to what the buyer and seller wants. So it is a casino, but at the same time, it is providing a service. It's a very interesting dichotomy between those two lines of thought. So, of course, on the one hand, yes, I suppose it's up to the regulators to make sure the market is functioning well, but also about us telling a captivating story about, how actually, to the just up oil people, or a lot of the pro environmental mates, like, yeah, we're actually doing a service. This is a great thing for the market. And going into the energy transition, there's also going to be a lot of people trading carbon credits, and there's many more renewable energy markets developing as well. So this trading stuff, it's here to stay, and it's best to actually understand what this all actually entails, so we're all on the same journey here.
Yeah, I do you know what? Something to link both what you were saying, Vincent, and you, Audrey. Like, the gambling has become a lot more sophisticated. So go on.
No, I was thinking exactly that. I mean, obviously you can be a super sophisticated gambler, or you can be like, there's two people at the races. There's me who punts on the horse with a funny name, or there's the guy who's been following the horse all year, who knows, like, the jockey, who knows all these amazing stats. And it's the same in the casino. You have the guy at the slot machine. You have the guy that's actually able to count cards. And it's the same in the oil market. Then you've got your really basic people that are like, oh, it's supply demand. And then you've got the more sophisticated guys that are monitoring flows, monitoring, where the like weaknesses are in the market, that kind of stuff.
And then you have the retail everyday trader.
Yeah.
But I was also going to say that the demand for retail trading, so the everyday is just so much bigger than it ever was.
Yeah.
The GameStop saga, cryptocurrency, this kind of stuff.
Crypto's making it really big, I think, and all the Netflix documentaries as well.
Right. So there's demand for it. It's like there's all this speculation going on oil markets, but there's a lot of demand for oil trading increasingly from the everyday person as well. And I think that is also a healthy thing. At least let's try and get some ownership of our exposures to our everyday prices, everyday things. Yeah. So Revolut was great for that, right? We have to pay a huge bid offer to banks, to exchange providers at the airport, to restaurants. Every time you do something abroad, you just get charged for it. You get some crap price. Revolut, you can transfer at market or very close to market. You can take ownership over your FX risk. And if you end up like doing it wrong, or you end up like, not making the saving you hoped or whatever else, I think people don't really care. It's about, we want the ownership. We want to know how we're getting screwed over, if we're getting screwed over.
Yeah.
And if we can do something about it, then we want to do something about it. It's just that classic thing. Like, would you not rather have ownership of, so we just got to accept that gas prices could be the highest ever for 10 years. Well, let me lock it in right now. And there's more of these kind of offerings coming in. So I think that could be positive as well. Like, rather than shun the financialization, we've got to differentiate between speculation and financialization.
Yeah.
Speculation is the buzzword for, pushing things to extremes and everything else. But financialization has a role. It can give you accountability or ownership over everyday things, if it's a sophisticated enough market. And that's what you need a lot of volume for. And that could be a real positive.
Yeah, no, I
so there you
totally
go. That's our
agree
theme for the podcast: bedtime stories and gambling.
Yeah.
I'm sure we could talk about this many more times, and I'm sure we will.
I think Ehsan asked me that. It was like the first thing he asked me when I joined. He's like, "Do you gamble?"
Yeah. It's I think it's with that mentality and with that idea of like gambling, it's really easy to explain the market. So I think it's like an entry into the financial markets. Talk about casinos, and then introduce all these products that now they are your blackjack and your roulette and this and that, and then there's the difference between them you can trade. That's another thing. And then these markets get more and more sophisticated because there is, to create that interest and to keep on entertaining people, in a way.
Yeah, there's entertainment. There's also we can't avoid these decisions in our lives. Everyone's a trader. You have to buy a house at some point. You don't have to. People try and buy houses a lot. You're buying clothes. You're making these decisions that you can choose to make money that way, or save money that way. There's all these things you can do. You can buy from America to the UK. This is trading, right? These decisions are trading. Or you can just not care about it. It's up to you. But you're not avoiding the mentality of a trader.
It's so funny that now that whenever I go out with my missus and I see like, oh, there's a price discrepancy between two things, I'm like, oh, there's an arb there. So yeah, it's definitely that. Like it
And then you go through the motion of how you close an arbitrage. So if it's got one shop is selling it 5p cheaper,
yeah,
Tesco's selling 5p cheaper than Sainsbury's, a baguette. How do you close that arbitrage? Well, you've got to buy enough of one and sell enough of the other in like the open market or whatever the discrepancy is. It will close once you've either instigated the issue, like, and they are aware and they then make the adjustment of the prices at Sainsbury's or Tesco,
yeah,
or you just take out all the stock of the baguettes. One and one. If it's going to just stay, it's hard for the arbitrage to stay closed if you take out all the baguettes, right? Because it's no longer on offer, and you know what I mean? Things like that. Understanding how arbitrage firstly exists and then how to close them gets you a bit more into how markets function and why liquidity and more financial trading is positive for markets. Yeah. Because these kind of things happen. There's no trader in the world is going to see Brent priced on ICE at one price and then Brent priced on CME at another price and not trade them if there's a discrepancy. Yeah. You would trade that in as much volume as you can. But what if you don't have enough volume to take down all the volume in the discrepancy? Then it can stay open. So you see what I mean? Like this, you learn about volume versus price discrepancy, you create inefficiency.
That's interesting that you mentioned that. Like in the oil market, is something quite, set that like if you see like discrepancy between two exchanges for the same product, you jump on that. Yeah. But like this was kind of new in the crypto space, right? That there was a trader that at the Bitcoin price in a US exchange, and there was another, same Bitcoin on a Japanese exchange, I think, if I'm not mistaken. Vincent, is this something that we've discussed, or like you showed me? So day in, day out, he would make, a lot of money just by buying here and selling there. No.
Why are you working on it?
The trader who would just use this like discrepancy between the two exchanges. But yeah, it's about
so the face value, there's a difference, and that is true. But if you go through the levels, it's like, okay, so how does it stay open? Well, remember there's risk to having positions on two exchanges. You build up a massive long on one exchange versus a massive short on a Japanese exchange. What if one of the exchanges goes down? Yeah. So, and that's very possible in crypto, right? Yeah. So there's the arbitrage that needs to be linked, but you're taking the risk on capitalization, and there's all these things that you have to get involved with. The more, as you said, like the more you understand all this together, the more you can stop shunning financialization rather than speculation, but the more you can kind of understand the complexities of how anything kind of builds, or at least markets build. You know what I mean?
Yeah, I mean, unless you're like a diehard like Marxist or anti-capitalist, otherwise you want to understand how the system actually works, and either of course understanding it, and perhaps if you want to seek some change, do it from within as well. So of course it's crucial to understand how the stuff trades, the risk and stuff. But it's quite complex, honestly. Like it's
of course
very combines everything. I think what we were talking about before, you have the markets, buying stuff and then arbing from Sainsbury's to Tesco's. It's a bit of economics. It's a bit of, I think economics is just, it's a bit of applied psychology. You're linking economics and the market and trading. Actually, it's all very very interesting. But at the same time, I think for most people, it's just the opportunity cost. For example, so we can go on and on.
Oh, there's lots of things that that five pence.
Yeah,
you need to like have like a really good justification for it, like bringing all the cost into it. How am I gonna negotiate this if I want to like buy a lot of it? Can I get a discount there if I want to like sell a lot of it? Do I need
it's not like you can buy from Tesco and sell to Sainsbury's. You need another buyer, third party buyer.
Yeah. And then like moving stuff around. Do I need to store this? Do I need to
it's gonna get stale. All that.
Well, what else are you buying, right? It's also about location as well. So, personal example recently.
Regional benchmarks.
Yes. 100%. I think we've...
Go on, tell us a story.
No, well, Yeah,
Bedtime
well,
stories.
Another story to
bedtime story and cooking some vegetables. You know, pak choy, 185 quid in Waitrose, and in Sainsbury's it's 125. It was 105 before, but damn, 20% inflation rise, right? They increased it to 125. But because of that, because I cook pak choy so much, I tend to go to Sainsbury's a bit more because the 60 cents actually makes a lot of difference for the same amount of food.
He can't afford his vegetables.
Yeah, but no, but you're saying it's
it.
the volume thing as well, as you say.
Yes.
It adds up when you apply the volume. Yeah, no, exactly. I think this would be good fodder for us, you know, as we go forward in this podcast. But I think we'll leave it there. And thanks very much for your time again, guys. And for everyone listening out there, thanks again. Please tune in next week.